Multiple streams of income. That's the holy grail of personal finance. Money coming in all over the place, right? That's the holy grail. They say the average millionaire has about 7 different streams of income, money coming in all over the place. But what they don't tell you is that initially we all start with one. Either usually it's their 9 to 5, their main source of income. And then from that, they begin to take money from that and begin to invest or create something to create the second stream of income. Welcome back to another episode of the MD Investor, the channel where we talk personal finance. If this is your first time, welcome. We're continuing our series of Black Wealth, all February 2024. And in this episode, we're going to talk about converting your active income to passive income. So yeah, this is the actual key. So this is the actual key, converting some of your active income to passive income. Because if we never convert income from active to passive, you will be stuck to the clock. You'll be stuck to the clock, meaning your income will always be tied to your time. And we're trying to separate them. We're trying to have our income separated from our time. So our income can be over here being generated, and we could be over here in Hawaii. Okay. The main income in the US is about $60,000, okay? Which means half of the income of the US is above 60,000, the other half is below. So I figured that's a good place to start. So $60,000, okay? $60,000, you're probably making about $30 an hour, right? Probably works at about $30 an hour. Most people are working about 2,000 hours per year. If you work 40 hours a week times 50 weeks, that's about 2,000 hours per year. Okay, so stay with me now. So we're using $60,000 as the main income, okay? And we have to start small. Let's say we want to replace 10% of our income. That's our goal to start. We want to replace 10% of our income, right? Because just remember, you become financially independent when you're able to generate your income without you working. Let me repeat that again. You become financially independent when you are able to generate your income passively. So if we're using $60,000 as the mean, when you're able to generate $60,000 in passive income per year, you are financially independent. Okay? I'm not going to talk about taxes, but in general, taxes are more favorable when your income is generated from dividends. And this is the income stream I'm going to talk about. Okay, so $60,000 is our mean. So $60,000 is the median income, and we want to replace 10% of that. So that is $6,000, right? Because 10% of $60,000 is $6,000. So we want to replace $6,000 in income. We want to earn $6,000 per year passively. How do we do that? We're going to look at dividend stocks, okay? There are tons of stocks that pays dividends. There are some stocks that don't pay dividends, right? Typically, they're considered growth stocks. Tesla is an example. Chipotle is another. Chipotle, Amazon, those are growth stocks. They don't pay dividends, but there's a lot of other companies that pays dividends. McDonald's, Pepsi, and so on. So when you buy a share of these stocks, you become a part owner, a little teeny owner of these companies. And these companies take part of their profits and return it back to the owners, the shareholders, which would be you after you own these stocks. So just remember, we're trying to replace 10% of our median income, which is $60,000, which is $6,000, and we're trying to earn $6,000 in dividends annually. So most companies that pays dividend pays it 4 times a year. They pay them quarterly. So it could be on the 3, 6, 9, 12 schedule. So March, June, September, and December, or it could be on the 2, 5, 8, 11 schedule, or in the 1, 4, 7, or 10 schedule. But the bottom line is they usually pay 4 times a year. There are some stocks that pay monthly, and they'll pay every month. Typically, they're in the real estate space. So $6,000 per year in dividends. We try to figure out how much would we have to invest. So the two things that we're going to have to think about in terms of how much we'd have to invest to earn $6,000 in dividends are going to be really two things. One is, what's the dividend yield? So the dividend yield is what the company's paying us annually in dividends as a percentage of the share price. So for example, if the company is paying us $5 per year and its share price is $100, 5% dividend over $100 would be a dividend yield of 5%. So we need to know the dividend yield. And why is that important? Well, it's important because when the dividend yield is low, we're getting a smaller amount back, right? Because if the dividend yield in that example was only 1% and the share price is $100, we're only getting $1 per year. If the dividend yield is 5%, we're getting $5, right? You may say $5 or $1 a year. What's the difference? That's only one of them is only $4 more. No, it's actually 5x. It's 5 times as much, right? So the dividend yield we'll have to look at. Companies can be a low yielder, but then they grow their dividend faster. So they have a low initial yield, but then they have a high dividend growth rate, which is the rate of how they grow the dividend from year to year. Companies can have a high dividend yield, but they don't grow the dividend at all. Okay? And the other thing too is that you can have something called a dividend. You can have something called a dividend yield trap, meaning the dividend can be high because the price is dropping, right? In that same example, if they're paying us $5 a year in dividend and the share price is 100, that's a 5% dividend yield. But then the share price drops to $50, and now it's $5 over 50. Now our dividend yield is now 10%. Sounds great. Your share price just dropped by half. It's terrible. It's worth half as much as it did before. And when that happens, usually there's a reason why the share price is dropping. And that's what they call a yield trap. Okay. The yield tells us how much money will we get per year from the stock. Mm-hmm. And then from that, we can take the $6,000 and divide it by how much we're getting annually in dividends from one share. And then that'll tell us how many shares we need in order to get the $6,000. And then after we find out how many shares we need, after that, we'll need to know how much of each share costs. Okay? So we said most companies are paying 4 times a year, and we need $6,000 per year. So that's about $1,500 in dividends every quarter, right? $1,500 in dividends every quarter. So we need $1,500 every quarter or every 3 months in dividends. So let's jump to my computer and look at some stocks that pays dividends. Okay, guys, so here we are in my computer on the Seeking Alpha website. And now we're going to try to really get detailed in terms of how much are we going to need. Okay, guys, here we are on my computer on the Seeking Alpha website, and we're going to try to get really detailed in exactly how much do we need to earn $6,000 per month passively. This is key. Just remember, we're taking the median income in the US, which is about $60,000, and we're trying to replace 10% of that income, okay? Which is $6,000. And we're trying to get that in dividend paying stock passively. So most companies pay every 3 months or 4 times a year, every quarter. So that's about $1,500 every 3 months. Okay, so we're gonna look at three different stocks. We're gonna look at a low yielder, such as something like Apple. We'll look at something in the mid range, maybe that pays something like 3 to 4%, and then we'll look at something a little higher, like something higher, not maybe about 8 or 9%, and then you'll see the dramatic difference in how much money you will need to invest. Okay, so here's Apple, probably the most valuable company around. Makes iPhones and computers and iPad and all that stuff. So first we need to look. So let's first look at dividends. How much does the company pay in dividends? So Apple pays 24 cents every quarter. Okay, 24 cents every quarter. Okay, and see we got some more information up here. So for the annually, it pays about 96 cents for the year, which is 24 cents times 4. But 24 cents per quarter. So that's one stock. Every stock of Apple pays 24 cents per quarter. We need $1,500 per quarter. So how do we find out how much shares of Apple we need to own to get $1,500? So we'll take $1,500, which is the amount that we want to get paid every quarter, $1,500. You divide that by 24 cents, which is how much each share is paying. And that will tell us the number of shares of Apple we need. So $1,500 divided by 0.24 or 24 cents lets us know we need $1,500 divided by 0.24, 24 cents. We need to own 6,250 shares of Apple. We need to own 6,250 shares of Apple, and we'll get $1,500 every quarter. But the thing we got to ask is, how much is each share of Apple? So we go up, and we see that each share of Apple right now is trading about $182.58. So you take $6,250 multiplied by $182.58, and it comes to $1,141,125. I know that's a lot. So $1,141,125. So that's almost over $1.1 million in Apple. And that's if you invested it. You have to invest it one time to get $1,500 every quarter. That is a lot. But that's because Apple's dividend yield, which we mentioned, is so low. Where is it? Let's look at Apple. Apple's dividend yield is only 0.52%. It's 0.5%. That's why. So the lower the dividend yield, the more money you have to put into it. So the lower the dividend yield, the more money you have to put in. Okay. Now let's look at something a little higher. Let's look at something like Coca-Cola. Ticker symbol KO. So Coca-Cola, let's look at the dividend yield. The dividend yield of Coca-Cola is 3.17%, right? So a lot higher than 0.5. 3.17% is the dividend yield of Coca-Cola. So how much do they pay for their dividends? We'll go to dividends and we'll see that Coca-Cola pays 49 cents every quarter. And they've been paying their dividend for a long time. So they'll be a dividend king. They've been paying it over 50 years. Okay. So, and it's going to be the same thing. How much do we have to invest in Coca-Cola to earn $1,500 per quarter or $6,000 per year? We're going to take $1,500, like we did before, divided by the dividend that we're going to get paid every quarter, divided by 49 cents, divided by 0.49 cents. This will tell us how many shares, the number of shares we need. So $1,500 divided by 0.49 cents gives us, we need 3,061 shares of Coca-Cola to earn $1,500 every quarter or $6,000 a year. 3,061.22 shares, okay? And each share is trading at $61.27. So 3,061 shares times $61.27. We'll need to invest $187,561.22 at a one-time lump sum in Coca-Cola. Notice it is a lot lower than the $1.1 million in Apple. The reason being, the Apple's dividend yield is so low, which means you have to invest so much money. But you look at Coca-Cola, it's not $1.1 million because the yield is higher, over 3%. We only have to invest $187,561. But you see the difference, right? Okay, now look at something a little higher, a higher yield. We'll look at Altria, ticker symbol MO. It's a cigarette company. The dividend yield for Altria is 9.58%. See, that's much higher. 9.58%, almost about three times as much as Coca-Cola. Again, we'll do the same thing. We're going to look and see the dividend and how much shares we'll need and how much we'll have to invest. Okay, so Altria is paying 98 cents per quarter for dividends. So what we'll do is we'll take $1,500 divided by 98 cents, which will tell us how many shares we need. So we'll need about 1,530.6 shares of Altria to get $1,500 per quarter or $6,000 per year. $1,530. 1,530.6 shares. And each share of Altria is trading at 41.19 or 41. Each share of Altria is trading at $41.19. So let's see how much we'll have to invest. Take the 1,530 shares times $41.19. So we will need to invest $63,045 in Altria to get $1,500 per quarter or $6,000 per year. You see the dramatic difference, right? We see with the Apple, we have to invest over $1 million because the yield was so low. With Coca-Cola, the yield was about 3.17%. We only had to invest about $187,000. But with Altria, with a yield of over 9.5%, we only have to invest $63,000. So that is the power of the yield. But again, we have to keep in mind yield traps. We can't have increasing because the yield is inversely related to the share price. If the share price is dropping, then the yield will go up. So you have to see why the yield going up. Is it because the share price is dropping? So we got to keep that in mind. But again, this would be replacing 10% of your income. So this would be replacing 10% of your income. It'd be $6,000 per year. Obviously, you wouldn't have 63. If you're only earning $60,000 a year, you're not gonna have $63,000 to invest in Altria. Not at one time, but you'd have to do it over time. You invest, you get the dividend, you reinvest it, you get the dividend, you keep reinvesting it, and that's how you'll gradually begin to replace a portion of your income. If you've gotten any value out of this guide, I'd appreciate a thumbs up, a like, a subscription. And until the next time, continue to command your money to grow. MD Investor out.